credits, in your opinion, would benefit if this indeed passed, the $1.9 trillion plan?
Sure. Look, I think a lot of the credits that were hit disproportionately hard by the COVID-19 shutdown are likely to benefit from increased, bigger, better stimulus. Obviously, they're the high-profile names like Illinois and MTA, but certainly sectors like healthcare and higher education and transportation in particular could benefit.
You talk about Illinois and the MTA, for example. Are those credits, if I may ask, ones that you stayed away from? Does stimulus change the game where you would get back in?
I think right now the market is pricing in a panacea from stimulus, that it's going to, in fact, solve all of our credit problems. And so while we believe that the MTA and Illinois are fundamentally sound credits and it will likely weather through this storm, there are times when they are more attractive from a relative value perspective and times when they are not. And I would say that right now, the market is pricing in perfection.
Interesting. Where are the opportunities, though, that you do see, particularly when it comes to federal help on some of the vaccine distribution, helping states compensate for some of the burden that carries financially, thinking healthcare, transportation sector? Are those opportunities?
Sure. I think the answer is unfortunately a little bit more nuanced, but at a macro level, I think, those are the kind of sectors that investors need to look at in order to unearth value in this market. The difficulty is that, as it turns out, not all airports are created equal, and the same goes for hospitals and continuing care retirement centers and higher education institutions.
There's been a lot of talk within the Treasury market, this reflationary trade, that it will eventually lead to inflation. How does that trickle down into the muni world?
Well, look, we've seen a backup in Treasury rates for sure, but we haven't seen a corresponding backup in municipal bond rates. And part of that is because demand has been very robust, and we're right in the middle of the January effect, which tends to hit the muni market every year. But I do think that there is room for municipal bonds to back up a little bit from a rate perspective, to normalize from a ratio perspective to treasuries. And so I do think that investors need to be a little bit concerned, not overly concerned, but a little bit concerned about their relative duration positioning and how much risk they're comfortable taking given those realities.
Are you seeing investors get too comfortable with the fact that revenue recognition from state and local cities is delayed? We might not feel the effects from this from a budgetary, a fiscal perspective for years to come?
I do. I think that is one kind of potential red flag. Look, we've seen revenue projections that look a lot rosier than anyone really would have predicted back in March of 2020. But what those revenue projections leave out is that there's still a potential expense snowball on the horizon, right? Tax revenues are high because high earners kept their jobs, because the stock market is high. That doesn't change the fact that there are a lot of people out there who are struggling, that need health care, that need education, that need housing for themselves and their families.
How do you play that then in the portfolio that you're overseeing?
Look, I think it really comes down to bottom-up fundamental credit analysis. You have to be careful and ready and willing to tear these things apart from the bottom up, track the revenue streams, and make sure they are fundamentally sound. And then obviously, there is some prediction that goes into the amount of stimulus we're likely to see, and maybe more importantly, how that trickles down to each and every one of these individual municipalities.